Can you contribute more to a solo 401k if you have an S corporation versus when you have a sole proprietorship? So in this video, that's the topic I'm going to uncover. I recently had someone reach out to me via email and had told me that the whole reason why they became an S corporation is so that they can put more money into a solo 401k. And this person was a little bit older, so they were trying to maximize their retirement. And as you'll see here in a second, that is not true. What this person was thinking about being able to contribute more with an S corporation than with a sole proprietorship is not true. And I want to make sure that you don't make the same mistake. Okay, so I'm going to show you how the sole proprietorship actually allows you to contribute more than an S corporation would as it relates to solo 401k contribution. So in order for me to do this, let me share my screen. But before I do so, let me quickly introduce myself if it's your first time watching. My name is Navi. I'm a certified public accountant that helps entrepreneurs save thousands of dollars in taxes. I do that by creating free content right here on social media, such as this video, and also through a comprehensive course, which is designed to convert business owners from knowing nothing about accounting and taxes and converting them into tax-savvy entrepreneurs who implement strategies that save them thousands of dollars each and every year. So if you're interested in learning more, you can click on the link within the description below, or even visit my website, which is navimuradcpa.com. All right, but what I want to show you in this video is the difference between sole prop and S corp. I have to cover that in order to answer the other question, which is how much can you contribute to a solo 401k if you're taxed as a sole prop as well as an S corporation. So let's quickly go over what I have here on the left. This, I'm saying you have a business, you're an entrepreneur, you're making about $125,000 in revenue, that's your sales. You have about $25,000 in expenses, so your business profit is $100,000, okay? Now, what happens here when you're a sole proprietorship is you pay Social Security and Medicare taxes on about $100,000 of your business profit. And so there's math behind this. The quick and dirty way to calculate this is to say 14% of 100,000. I've got the exact number here. So you're going to pay Social Security and Medicare taxes. Specifically, this would be called self-employment taxes when you're a sole proprietor, of $14,129, and that would get rounded out to $14,130. So you also would have to pay income tax, right? You made $100,000. This $100,000 would be subject to the standard deduction, any adjustments to your gross income, things like this, and the money would flow through the federal income tax brackets, and you would have to pay $10,000 in federal income tax for a total of $24,193.55, right? So it's a lot of tax. It's like a 24% tax rate if you compare it to what your revenue was, or I should say what your business profit was. S corporation, same thing happens, right? You made $125,000 in revenue, $25,000 in expenses, you had $100,000 in profit. But here, what you're doing, just in case you've never heard this about the S corporation and how this works and saves taxes, I'll explain it here real quick. Here, how this works is we're taking our $100,000 and splitting it into two buckets. $40,000 will be this person's reasonable compensation, and $60,000 will be in the other bucket and what we'll call a distribution, okay? What happens here is that this entrepreneur only has to pay Social Security and Medicare taxes on the amount that they pay themselves as reasonable compensation. I won't go through all the details of this, but essentially the math is 15.3% of this number. $40,000 times 15.3% is $6,120. So there is a Social Security and Medicare tax savings of almost, not almost, but $8,000 when you compare this to the sole proprietorship, right? The sole proprietorship again was $14,130. Here we have $6,120. Now, federal income taxes, the S corporation actually, if you have your business taxed this way, you'll pay a little bit more income tax. The reason behind that is, there are multiple reasons, but one reason behind that is the qualified business income deduction is reduced when you are an S corporation compared to that of a sole proprietorship. So you're going to pay $11,626 in federal income tax. So your total taxes paid here was $17,746, a tax savings of roughly $6,500. Okay, this is on a $100,000 profit. The more profitable your sole proprietorship would be, the more tax savings you would incur. Now, that's how the taxes work for a sole prop versus an S corporation. And by the way, if your business was taxed as a partnership and there was, let's say, two partners and your profit made $200,000 in profit, your business made $200,000 in profit rather, it would be the same thing here. It's just that each partner in the partnership would have to be paying these taxes, right? Because you had, again, I'm assuming $250,000 in revenue, 50,000. Well, you probably still have. Let's just assume you had $50,000 in expenses, and so you had $200,000 in business profit. And so each partner in the partnership would be paying $24,194 in taxes. Okay, just wanted to explain how that works in a partnership, just in case you were wondering. All right, now the topic of this video is how much can you contribute to a solo 401k if your business is taxed as a sole proprietorship versus an S corp. And so here you're going to see that like with a sole proprietorship, you can actually put more money in your retirement account based on these facts and circumstances. Okay, so in 2024, the max you can contribute is $69,000. And the way this is calculated as a sole proprietorship is you need to calculate what your self-employment income is. I've done that math for you. It's $92,935. It's basically your business profit minus half of your self-employment taxes. That's how this number was generated. Then there's a formula to calculate your profit sharing contribution. It's essentially 20% of this number. So 20% of this number is how much you can contribute, and I call it profit sharing. Okay, you might hear this called like the employer match. Okay, that's what I'm referring to here when I say this. You can sort of defer your salary, if you will, into the 401k. So that's the amount you can defer in 2024 is $23,000. And so you have $41,587.05. But then if you wanted to, you can actually make a voluntary after-tax contribution. Now, typically you're only doing this if you are the only employee in your business. There might be some rules where you can have some part-time employees, but if you're only the employee in your business, meaning you don't have other full-time employees, then you can make this voluntary after-tax contribution to arrive at the total of $69,000. Meaning, with your business profit of $100,000, there is a way to contribute $69,000 as a sole proprietor. Now, what if you elected to have your business taxed as an S corporation? What would be occurring here? Well, you can still make a profit sharing contribution. Again, you might refer to that as the employer match, but it's limited. It's limited to 25% of the amount you paid yourself in the form of reasonable compensation. So it's 25% of the $40,000 or $10,000. Okay. You can also defer of your $40,000. You can defer up to $23,000 of it into the 401k. And you can do that into a pre-tax account, sometimes referred to as a traditional account, or you could do it into Roth. Same thing applied here for the sole proprietorship, by the way. Either these $23,000 could be pre-tax or Roth dollars. Now, if you add that, those two figures up together, you get $33,000. And here, with the solo 401k, you can also make a voluntary after-tax contribution, but it's limited. The math on this is a little complex. I won't walk you through all the details, but the amount that you can do is a formula based on the amount that you paid yourself. So bottom line is $13,940 is the voluntary after-tax contribution for a total of $46,940. So there's a difference of $22,060. So if you came to me and you said, Navi, my primary objective with my business is to save money for retirement, which one could I max out? And I were to ignore all other factors, I would actually encourage you to be a sole proprietorship in this example versus a S corporation, because with the sole proprietorship, as you saw, you can add or contribute $22,000 more dollars each and every year. Now, again, the partnership example would be the same thing as it was here. Again, essentially with the partnership, I'm just assuming you had double the business profit. So each partner, assuming they were 50% business, 50% business owners, would be able to contribute this amount. That would be allowed as long as there were no other full-time employees in the partnership, and it was just the two partners contributing to the business and the only employees in the business, if you will. All right, so I just wanted to create this quick video and show you that there's many factors that go into, deciding what type of entity is right for me. So if you ask a question in the comments that say, hey, should I be an S Corp? This is what I plan on doing. I can never answer that question without actually fully analyzing the situation. So these are the type of things that I teach in my course, how to maximize your Roth IRA, backdoor Roth IRA, all these different strategies. Obviously not limited to just this, but hiring your children, picking the right tax entity, and all these different things. And so you can find out more again on my website. It's navimuradcpa.com. And I encourage you to join other entrepreneurs who have saved thousands of dollars in taxes by going through the content on my course and applying those strategies to their own business. So thanks so much for watching, and I'll see you in the next video.